Hi, I'm Rob Mitchell with Market Traders Journal. Thanks for joining me for Trader's Secrets, which chart types give you an edge and which don't. This webinar has a lot of information in it, and so we're going to move really fast because I have a lot I want to cover on this subject, and so let's get right into it. First off, let's cover our disclaimer. Past performance is not necessarily indicative of future results. There's a risk of loss trading futures. Let me tell you a little bit about myself before we get started. As I said, my name is Rob Mitchell. I'm president of Axiom Research and Trading, and we do market research and trading, and I'm also founder of Market Traders Journal. I've managed quite a bit of money at various times in the millions of dollars, and I've won trading championships, and I've developed any number of successful trading systems over the years. A recent LA Times article showed that 70 to 80% of all accounts were unprofitable on a quarterly basis. This is actually a pretty staggering statistic. Traders consistently lose money, I believe, for two main reasons. Number one is undercapitalization, and number two is the inability to trade consistently. And there are a variety of factors as to why the inability to trade consistently occurs, and part of that we're going to cover in today's webinar. First steps to a solution. The single most important thing we can do as traders is set up our charts to feed good data to our indicators and set them up in a way that we can see patterns. This is important because the way we set up our charts and organize our data significantly influences how we're able to interpret what's there. Good trading decisions are more easily made from well-organized data. And this is a topic that is rarely, if ever, taught, and yet it is an extremely important topic because it is the building block from which all analysis and trading occurs. Basic chart types. There are four basic chart types that we recently did a research project on. There's time-based charts, tick charts, volume charts, and range-based charts. And each of these has little different characteristics that we're going to go over here. We analyze these in the intraday time frame specifically in order to compare the various chart types and how they acted. Now, there are two dimensions on a chart that can be seen: the price axis, the y-axis, and the time axis. And so in some of the tests, the most basic one that I'd like to talk about today, there are many of them, but we analyze the orientation of these chart types in the time and price axis. And so what we did was we set the charts up so that they would approximate each other so the testing would be accurate. And first we tested where bars were closing in their range inside of a trend or interval of range expansion. And this is what we found. Before I go there, though, I want to say, typically, you're feeding into your indicators, for example, the closing price of a bar. And so where you're closing in the range becomes a critical factor in the way your charts feed their information into your indicators. And so it's important where bars close in their range that it is a meaningful type of piece of data. And so keep that in mind as we go forward. First off, there are volume bars, and we did this study, and what we did was we measured the percent of bars that closed in their directional extreme when going with a trend. Now, this isn't difficult to do. You can do this test yourself. Essentially take any zone between a high and a low and count on your volume bars how frequently it's closing at the directional extreme. If the trend was up, you ask yourself, well, how often does it close within one tick or at the high of the bar? Well, it's going up. When it's going down, similarly, you take that measure. And this is what we found over various intervals, that volume bars close at their directional extreme 32% of the time. Let's go take a look at tick bars. Tick bars closed in their directional extreme 25% of the time. That's pretty staggering when you consider that there's no way that such a close can be statistically significant in any way when it's only closing in there in the directional extreme 25% of the time. On time-based bars, it's even worse, only about 12% of the time. And so it's very, very inconsistent, these bars, as to how they represent. Now, a range-based bar, of course, closes in its directional extreme about 72 or 73% of the time. And, of course, this is true because, by definition, a range-based bar will close at its high or low before it goes on to make the next bar. That's the nature of the way range-based bars work. This actually makes range-based bars a superior type of a bar, particularly if you're trend trading, but it is also gives up some things in exchange for that. So if we look at these all together, you can see 32, 25, 12, and about 73%. Now here's an interesting topic. My guess is that the most commonly used bars are time-based bars, and that's why they're so random, because there are traders doing all kinds of things inside those time-based bars. There are other disadvantages to time-based bars too we're going to cover in a few minutes. Now, similarly, the ES, which is the most commonly traded market, the E-mini S&Ps, is, when you look at the charts, very often the most random in terms of where it closes. And this is true, I believe, because it is in fact the most popular market. So there's a randomness to it, but at the same time, the ES, the S&P also keeps itself in a tighter range than, say, a similar market like the Russell futures. Just throwing that in there, it's kind of a theory of mine that you want to be trading or setting up your charts in a way that other traders aren't doing. Otherwise, you're just getting thrown into randomness. That's the idea that I'm trying to get at there. Now, what they don't tell you at chart school. What this told us, this research project, was that the close of a bar is basically random. Anything like a candlestick pattern analysis or any indicator that computes based on the close of the bar, for example, will be getting fed random data. Then your charts that you use to make trading decisions will be inconsistent over time. And what I mean by this is, when you look at a pattern that's setting up with bars that are doing this at one time, and you look at the same thing, the same pattern at another time, there's an element of randomness that is introduced into the way that's presented to you in your bar charts. This is a statistical fact. It's not a matter of, debate, that they will present themselves differently. Why do we know that? Well, on a time-based chart, you only close in that direction 12% of the time, 13% of the time. So there's this random component there. And so there's a wide range of ways that a pattern on a chart will be represented over those time periods at various times, even though it's the same pattern. Chart patterning is important, and it strongly influences our indicators and our ability to analyze and make trading decisions. In other words, the charts used by 99% of all traders have a random component in them in terms of where the bar is closing in its range. And further, the type of individual bar that is formed in most cases does not tell the chart reader whether the market's bullish, bearish, or consolidating, because it has no directional bias. Remember, again, less than 50% shows no directional bias. The exception here was the range bars, as we recall. This is no small point. Further studies show that about 90% of all market movement occurs in about 10% of the time. This is no small point either. What happens is markets make really abrupt moves and then they consolidate, really abrupt moves and they consolidate. So if you're not onto what's going on early in the game, your risk goes way up and your reward potential goes way down. So it's really important to be able to identify when a market is in fact moving or not. Let's define a few things about various bars that are currently available in your charting package and see where that takes us. Benefits and detriments of various bar types. In 3 of the 4 bar types we've analyzed, the time axis can have more or less bars in any interval of time. Only on time-based bars is the axis consistent or constant. For example, on time-based bars, the axis may generate a bar in each 5-minute interval. I put a chart on here. This happens to be a 3-minute chart. As you can see, that gigantic bar at 5:30, that happens to be when reports come out. You get that big bar, range expansion bar, and then the market consolidates. This is exactly what we were talking about. And then it comes back up after the market opens and starts trending again. Now, if you use time-based bars in your trading and you're triggering off of the bars, very often you'll miss trades because the range expansions will leave you out of the game. Now, we saw that time-based bars only close at the directional extreme about 12 or 13% of the time. For this reason, many traders who know better will use range, tick, or volume bars, depending on what you're trying to accomplish. Range, tick, and volume bars will vary in their frequency on the time axis of your charts. Let's look at each chart type. Range bars will generate a new bar each time the specified range is exceeded. So for example, if you're set to 4 ticks of range, a new bar will be generated if that range is exceeded. For example, on the 5th tick. Now here are the pros and cons of range bars. It can show a trend quite well if it's set correctly, and it hides detail. Let's go over and look at this chart while we're talking about it. It hides detail and is only sensitive to certain scales, and it cannot adjust itself to varying market conditions. It can go stagnant for long periods of time when the range gets quiet, and as you can see, it becomes very jumpy. There are different kinds of range bars that you can solve this sort of gappy problem, but that's beyond the scope of this particular webinar. Range bars, as we had said, have a lot of advantages to them, but when the market is consolidating, it can get you into a lot of trouble. Tick bars will generate a new bar each time the specified number of ticks is exceeded. So for example, if you're set to 1,000 ticks, a new bar will be generated if that count is exceeded. On the 1,001st tick, a new bar starts as with tick 1. Now here's some of the pros of tick bars. They can be more sensitive in market turns and breakouts, superior to time-based bars certainly, by any measure. They can show more detail and can be sensitive to changing scale of the market, can adjust themselves to varying market conditions, and can do all the above while being less active in quiet markets. This can help to keep you out of whipsaw types of situations. Here's an example of a tick bar chart, a 3400 tick on the ES. You'll also notice that as we're looking at this, that the bars are showing tails on each end in a large number of cases, and this is what we're talking about closing in the directional extreme only about 12% of the time. Now let's go on to volume bars. Volume bars are like tick bars, but they work off actual trades or market orders. Volume bars will generate a new bar each time the specified amount of bid-ask volume is exceeded, similar to the tick bar. Now the pros of volume bars is similar to tick bars again. They can be more sensitive in market turns and breakouts. They're superior to time-based bars. They show more detail and can be sensitive to changing scale of the market. They can adjust themselves to varying market conditions and can do the above while being less active in quiet markets. In other words, they don't generate a lot of bars in quiet markets. Let's look at a volume chart. Similarly, you get these tails on each end of the bars pretty consistently, regardless of the direction of the market. So any one of these bars, just on glance, cannot tell you what direction the trend is going in. Let's look at some of the cons of volume and tick bars. Volume and tick bars are non-directional. They do not identify buy-sell pressure and relate it to a bar range expansion. As a result, they are random in the representation of data. As we've seen, 32 and 25% of the time they close in the directional extreme. Therefore, analysis of individual bars and bar clusters in the intraday time frame is random. This is probably fine if you use, say, moving averages to some extent because they smooth that out. They smooth that randomness out. But if you are doing pattern analysis of any kind, such as candlestick analysis, or feeding this data to most indicators, then time, tick, volume, and range bars are inadequate and may in fact be dangerous to use for analysis. This is a trader secret that nobody talks about. If you get a lot of bars occurring, a lot of volume on or ticks occurring in a span of time, what you're going to get is this kind of random sideways movement in the market like we see in here. And then what happens in these is you get like a 1-point range in a cycle that's 3 points. And this is a death trap for any trader getting caught in that. As that market goes higher, it lures in a bunch of longs in the middle of the magenta area, and then it breaks lower, lures them in short, and they get whipsawed, and that's a way to add up a lot of losses really quickly. This occurs on volume and tick bars because of a lot of volume that occurs. And when the reason that volume and tick bars have these tails on each end, this kind of randomness, is because their way they're designed is completely non-directional. And we'll cover that some more in a few moments. Now, when analyzing charts, it's important to be able to see patterns on the charts. The purest form of trading is pattern trading, and it is pattern or structure on your charts that feeds your trading engine or strategy and your indicators. Patterns on charts our most fundamental form of analysis and are also a form of order flow analysis. If you can see chart formations, then you can tell who's in control, bulls or bears. Traditional bar types obscure this view and make chart analysis more random in the intraday time frames. Traditional bar types also make indicator computation have a random component, as we've discussed, and they may feed your indicators random information. Now, they also fail to show what type of trader is participating in the current price action. New money, which I call smart money, or dumb money, old money. This is a difference between new money entering a market on a rally or dumb money getting stopped out, short covering or long liquidation, for example. The time factor. As mentioned, range and volume and tick bars can vary in how often they're occurring on the time axis. In trending markets, range, volume, and tick bars will have more bars in a quiet market, or rather less bars in quiet markets and more bars in moving markets. Range bars will do this consistently and will create a constant relationship between price expansion and time. Range bars show price expansion exclusively. Because of this, range bars will never miss a breakout, but they will not show you a lot of detail in the underlying pressures that are moving a market. And so that is what you give up in exchange for having that bar that is showing you range expansion. Now, the volume and tick bars will generate new bars based on total ticks or total bid-ask volume, as we've discussed, without regard to the directionality of the buy or sell pressure. And that's why you get that random chunk in that magenta area that we just looked at. This disadvantage makes volume and tick bars somewhat random in their presentation on your charts. And they are relating total buy-sell pressure to price movement, which may or may not be directional. The pressure factor, what you cannot see on your charts. And remember, we said there's two things you can see on your charts, the x-axis and the y-axis, time-price relationships. To some extent, volume and tick bars show overall buy-sell pressure, but do not help you to identify or relate price movement and the underlying pressure associated with it. These bars are non-directional, in other words. That's why you get those tails on each side. Price goes up and down, right? And so if this is the case, then why wouldn't you want to connect buy orders with upside price movement and sell orders with downside price movement? That would be an entirely different way of looking at bars that related them to price movement, and you would directly relate directional movement in the market with the orders that were connected to them. This way you can see there are two, if the two are moving together or not, whether or not volume, directional volume, is moving price up or down, or if it's failing to do so. So what if your chart showed real buy-sell pressure and related it to real price movement? If we were able to have a bar that showed us price movement according to the actual buy-sell pressure that existed in the market, what would it look like? We'd be able to see by glancing at our charts if the market was trending or not, because it would take on the characteristics of the directional pressure similar to a range-based bar, but without giving up the detail. Bars would no longer be random because they'd be generated specifically based on that buy and sell pressure underlying the bar. Buy-related activity connected to upward movement, sell-related activity connected to downward movement. This would make charts highly meaningful and would also make the individual bars themselves meaningful. This is a key point. So, let's go back over and take a quick look at the four types of bars. We saw volume bars 32% of the time in the directional extreme, tick bars 25%, time-based bars 12%, and range-based bars 72%, but giving up detail. Now, what would happen if we did what we've just discussed? If we connected upside buy pressure with upside movement in the bar and downside sell pressure with downside movement in the bar, what would we get? We would get a bar that closed in the directional extreme 65% of the time and would do so with remarkable consistency in all test intervals, as opposed to other types that are very inconsistent over time. I didn't actually point that out, but if you look at the range, you go from 0 to 38% of the time here. Here you get 20 to 63%. On the time-based bars, it's 0 to 22%. And on the range-based bars, you're actually a little bit more consistent because of that nature of the bar. But when you connect this buy-sell pressure with the price movement that's underlying it, you're very consistently around the 65% of the time mark with a very small variance. As a matter of fact, the variance on these others is many, many times larger than it is with a bar that's being computed in this particular manner. So, in fact, a bar of this type will actually close at its higher low about 80% of the time and about 65% of the time in a trend. Like we said, closing at the directional extreme about 65% of the time. So when compared to other bar types, it's remarkably consistent, but it doesn't give up any resolution in the process. And this is particularly true in intraday time frames. Now, when compared to other bar types, it's a huge edge because it relates price movement to actual buy-sell pressure and the bar generation rate, the frequency at which the bars are being generated. Now, when we do this, chart analysis becomes greatly simplified, more intuitive, consistent, and reliable. In fact, it greatly simplifies candlestick charts to only basically two bar types. And so those that close at their high or low and those that do not. This in itself is extremely significant for both your indicators and the results that you get overall. It makes it easier to identify trend, consolidation, and breakout. And I call these bars ultimate tick bars, and I have a patent pending on them. They're only available through my website, which I'll tell you about later. And they work with NinjaTrader at this time. Now, this is what ultimate tick bars look like on a chart. And you can see as these bars move lower, you'll see as it moves lower, the bars will close in their directional extreme a very high percentage of the time. And then when the market moves higher, they'll close in its directional extreme as well. When the market's consolidating, you'll generate fewer bars in general. This is going into the close of the day. But this is a very clear patterning when the market goes into a breakout mode and starts moving. Very clear. Ultimate tick bars. Let's look at some comparisons between ultimate tick bars and the other bar types that we've been talking about here. This one up here is a range, 4 range chart. And what we're looking at is an area. What I have done, as I said in the beginning, we match these up as closely as we can so that they fit over this time span. You can see that the UTBs are smoother, and they show micro patterns that enable you to hop on trends. This is part of the problem with a range bar. You lose that resolution. You can see these little micro retracements that occur, bar encompassing patterns. I have an article that I'll tell you about later on Market Traders Journal. You can get it there, that teaches how to trade these micro patterns to hop on these trends with relatively low risk. This one is a volume bars, and as you can see, the bars closing with tails on both sides. When you get in a really extreme trend, they will close in their directional extreme a little higher percentage of the time. This is the same period of time that we just looked at on the range chart. The UTBs close at their low in the downtrend. The tick-based charts are more random, and they close just about anywhere in the bar, even during a trend. And so they also this also occurs with tick-based charts. We can go over and look at the tick chart. You can see that this same type of patterning occurs. Now, the tick-based charts have can have bars that have big range expansions and also, but when you see that, it's generally, that's another pattern that I write about in the ebook that I'll tell you about later. But as you get these large bars, that's generally related to short covering activity here. And so the actual shapes of the bars are giving you specific information about the type of order flow that's going on. Here's one with the time-based chart, and as we mentioned, time-based is just the absolute pits because the bars don't care anything about range expansion or the buy-sell pressure that is moving those markets. Now, because UTBs are directional, you know that when there is a new UTB bar, it alerts you to buy and sell pressure that is influencing the market. No other bar can do this. There's many times tick or volume bars will generate bars that will mislead you as to the direction. And this is because the bar doesn't close in the direction, the bars themselves don't really tell you anything about the direction the market's going in a good percentage of the time, as we've discussed. Now, a UTB will be smoother, and it'll offer more resolution and let you see if the market is trending or in consolidation better than any other bar type. As a result, trading with UTBs lowers your risk, and it increases your reward potential, while at the same time making trading more intuitive and natural. And when you feed this type of information into your indicators, it can make them much faster. The UTBs are also kind of like having a squawk box, because when they start generating bars at a high rate, it really tells you that there's motivated activity in the direction that the market is moving. Now, let's summarize what we've covered here. In the beginning of this webinar, we discussed that traders most often lose because of their inability to trade consistency and or due to undercapitalization. We also discussed how the way we set up our charts influences what we see and what we're able to interpret and the impact it has on our indicators. Ultimate tick bars make the relationship between price movement and the pressure that drives it direct, and this makes it easy to see the patterns, and it makes our indicator readings much more clear. Traders also lose money because on most charts, the range or height of the bars are large with respect to the cycle that's actually being traded. We saw that in the magenta area, if you'll recall. You have a 3-point cycle with 1-point bars. And so by the time you get in, you're risking a point essentially to make a point, and more often than not, it ends up being nothing. And this was one of my first lessons in trading as I became a trader in my early years. UTBs reduce risk because they show you the micro patterns, and they also tell you when there's strong buy or sell pressure occurring that you can't see in other bar types. This helps you substantially with undercapitalization issues and makes trading with small stops more possible. UTBs make the bars in your charts consistent, and it makes your charts work in the way markets are actually structured. Upward moving markets have buy pressure associated with them. Downward moving markets have sell pressure associated with them. No other bar in existence does this. And so UTBs become small in trends. The bars, as the market starts trending, the bars get very small, making this ratio between the height of the bar and the range that is occurring much more advantageous. And this equals improved opportunity at lower risk. As a result, UTBs structure your charts in the way traders need most to be successful. This is not a small edge, and as you've seen, it's statistically reliable over time because the bars are utterly consistent. We have covered all the different types of bars that are available in your charting package and the various pros and cons of each. There are other variations on various types of bars, for example, different variations on range-based bars, for example, but the same rules will apply overall. Much more could have been said to illuminate these factors, but time constraints do not allow. There are many articles that I have. I'll give you a resource on that in a moment. We saw that UTBs are smoother and give excellent price and directional resolution, making it possible to hop on trends with low risk and even determine trend by looking at as little as one bar. Now, I have some resources here for you. I've created more advanced learning and trading videos on UTBs so that you can learn how to use them in real trading at my free blog called Market Traders Journal. Market Traders Journal is an educational resource for traders. It's free, but registration is required. It only takes a second to register there. And we also have a daily trading plan there. And so you can see a video on the home page there that'll link you into more advanced training on UTBs. There's also an article there that you can sign up for. It's a small ebook that covers some of these different micro patterns for trading UTBs. So be sure and get that on Market Traders Journal on the home page on the right-hand side there. You'll see it. You can also learn more about them on my blog. There's a category on the blog called Ultimate Tick Bars, and there are any number of articles there. You can also buy these bars, if you like to, at Market Traders Journal. Now, Market Traders Journal is also, as I'd mentioned, the home of the daily trading plan. And so there's no cost for this, but as I said, registration is required. and I put out a daily trading plan with key levels in the stock indexes each day at no cost to you that uses volume profiling techniques. And I also offer ongoing support, so if you have questions, you can contact me, support@markettradersjournal.com. And I also, you can also get more educational information about UTBs and their use at daytradingdivergence.com. And another resource for information is my YouTube channel called YouTube Nindicators channel, youtube.com/user/Nindicators. You can go visit that there. There are links to that off of the Market Traders Journal, actually all these things off the Market Traders Journal site. So if you can get to the Market Traders Journal site, there will be resources there that can get you onto these various other resources. So that's what I have for you today. Thanks very much for joining me for this webinar, Trader Secrets, which chart types give you an edge and which don't. I hope I was able to bring something to the table for you about the implications of the various types of charts that you use and what the advantages and disadvantages of each type might be and how it impacts you as a trader. And also, I'd like to put out a big thanks to Larry Jacobs and Traders World for putting on the expo and seeing to it that the various educational resources are made available to you during the time of the expo. So thanks again, and we'll see you again soon.